Hello, everybody. It's Monday, March 13th, and this is today's technical analysis lesson. So, what I'm going to do is just kind of bring up a random chart every day and just see what we can learn. I think every chart teaches a story, and that's because when we're looking at charts, we are looking at a graphical illustration of human emotion. And people trade all kinds of different things, so that's why we see these patterns reoccurring in similar patterns in different types of securities. Now, what do I mean by mass psychology? Well, look at this here. So this is our Spider Energy ETF. The symbol is XLE. And notice how back here in September and probably late October, 83 was clear resistance. Resistance is a level where there's more supply than demand, or more shares for sale than there is to be bought. So when the market's moving higher, it's because the buyers can't find enough shares to buy. There's not enough supply, so they're forced to be able to pay premiums to get the sellers off of the sidelines. But when we get to a resistance level, well, that changes. The buyers can buy all they want to. Now, sometimes when we get to resistance, we have a quick sell-off, like we can see here. Why does that happen? Well, investors who are trying to sell, the investors who are creating the resistance with their sell order, they start to sense that there are other sellers around. That's why the shares aren't moving higher anymore. And they start to think, if someone goes to 82.90 and I'm at 83, I'm not going to be able to sell my shares. The buyer's just going to go to the lower price. So I'm going to go down to 82.90 as well. And then it starts a snowball effect. Other sellers see that you're cutting your price, they're cutting their price. So this is the snowball effect. Now, notice how this resistance here turned into support here and here to within like a precise, probably 25 cents. All right. This is when you look at charts, or my philosophy on technical analysis is it's about the levels, it's about the trends, and it's about the momentum. We don't worry about silly things like, Fibonacci and Elliott wave. I mean, in my opinion, that stuff is science fiction. I mean, if you want to use it, go ahead. But I'll tell you this, no one in the institutional world uses that. And I know because I was in the institutional trading world for more than 20 years. I actually traded for Mario Gabelli and Steve Cohen, two of the greatest ever. But anyway, resistance becomes support and support again. How does this happen? Well, a lot of the investors who sold here start to experience seller's remorse when the price goes higher. And they tell themselves, I shouldn't have sold. I made a mistake. So I'm going to try to buy my shares back, but I'm only going to do so if I can get them for the same price that I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, if there's enough of these buy orders, the level that was resistance converts it to support, like happened here. And now up here, we can see support around the 88 level converted into resistance and then back into support. Now, why would support turn into resistance? Well, this is because of buyer's remorse. A lot of the investors who bought here regretted doing so when the price went lower. A lot of them tell themselves, I'm going to sell, I made a mistake, but I'm only going to get out if I can get out at break even. So if we have enough remorseful buyers placing their sell orders at a level that was support, the level that was support can convert into resistance. And as we can see here, we converted back into support. Now, sometimes you have something like this. This is what we call market memory. We peaked out right around this $94 level in November, and we peaked out right around this $94 level in February. Market memory, sometimes a level that's resistance or support, they can stay intact for a long time. Now, support is the opposite of resistance. Support is a level where there's more demand than there is supply, or more buy orders than there are sell orders. So if a market's going lower, it's because the sellers can't find buyers to absorb their shares. So they're forced to offer their shares out at a discount. So they'll, in order to attract buyers off the sidelines. But when we get down here, well, all of a sudden there is enough demand. Sellers can sell all they want to. And this is the opposite. The buyers start to think that, oh, there's other buyers around. That's why the price isn't going lower. Maybe I'm going to raise my price and get ahead of them, because the seller is going to go to whoever has the highest price. I mean, if you're bidding 83 and there's someone who's bidding 83 and a quarter or 83.25, well, they're going to go to the person who's bidding 83.25. So the buyers start to sense there are other buyers around, and they raise their price, and that starts the snowball effect. All right. So a lot of times when we get to support, just like when we get to resistance, we sell off. A lot of times when we get to support, we bounce. Now here we have support breaking. What does that mean? Well, if the price trades below the support level, it tells us something. It tells us that the buyers or the investors who created the support with their buy orders have left the market. Now, anytime you take demand or buyers out of a market, it sets the stage up for the supply side of the equation or the sellers to push the shares lower. Take demand out of a market, there's a good chance the market's going to go lower, regardless of what market it is, whether it's a stock market, crypto market, real estate market. This is pretty interesting down here, too. Another thing I see here. This is what we call a gap. Notice how we got this gap here, and then we got a gap going back up. So a gap is, let me just use, I'm going to go back to my laser pointer here. So a gap is a level where, or price levels where there was no trading. So on this particular day, we closed here. The next day, we opened here. Notice how we didn't trade there. When we started to rally, when people thought to themselves, oh, well, that news isn't as bad as we first thought, let's go buy some. Notice how it gaps back up. Well, we just explained how one of the reasons why there is resistance is because there's buyer's remorse. People bought and they want to sell when the price goes lower, but they're only going to sell at the price that they bought their shares at so they can get out at break even. Now, when you have a gap, guess what? Nothing traded in between these two price levels. So therefore, when the market reverses and comes back up, there's not a lot of supply or there's not a lot of sellers around because there's no remorseful buyers trying to sell. So this means the buyers have to be willing to pay much higher prices, and that forces the uptrend. So all charts need to be looked at through the context of supply and demand, and every chart, in my opinion, tells a story, and this one is certainly no exception. Okay, thank you, everybody. I will see you tomorrow.